10 factors you need to know which affect your D&B report. Dun & Bradstreet is the oldest and largest credit reporting agency. You must have a DUNS number to start building business credit. No DUNS number? Then get one. They're free. The number gets your business into their system. Their main score is Paydex, but a business will not get a Paydex score unless it has at least 3 trade lines reporting, plus a DUNS number. A business must have both to get a score or a report from D&B. D&B reports are one of the first things a creditor will check when deciding whether to extend credit. D&B offers database-generated reports. These help their clients decide whether a business is a good credit risk. Companies use these reports to make informed business credit decisions and avoid bad debt. Several factors go into creating such a report. In general, when D&B does not have all of the information they need, they will indicate that in their reports. However, missing information does not necessarily mean a firm is a poor credit risk. Instead, the risk is unknown. Any report is only as good as the data it comes from. D&B's database contains over 250 million companies around the world. It includes around 120 active firms and about 130 million companies which are out of business. But these are kept for historical purposes. D&B continuously gathers data. It works to improve its analysis to assure the greatest degree of accuracy possible. To ensure an accurate report is possible, it quite literally pays to provide D&B with your company's current financial statements. D&B data starts with self-reporting by borrowers. When a business fills out a credit application, they provide data for credit reporting agencies, such as amount of time in business, industry classification, and number of employees. This also includes voluntary reporting by creditors. It's an advantage for creditors to report because if borrowers know a company reports, such borrowers may pay faster to maintain better scores. They can reward good credit to conscientious borrowers who pay back on time, and reporting alerts other creditors that a company has borrowed and thereby may be about to overextend itself, which means it might not be able to promptly pay its obligations. D&B data sources vary. They include public records, such as bankruptcies, liens, and judgments. The information is often from court documents. IRS information is usually tax lien filings. The IRS also has information on whether a company is a sole proprietorship, partnership, corporation, etc. This gives information on the makeup of a company. Shared data is another source. Credit reporting agencies receive payment data and other company details from lenders, suppliers, and creditors where a company has accounts. This is from vendors which report. Collection filing listings include date, status, collection agency name, amounts disputed and collected, and the close date if applicable. UCC filings are another source of information. If your business was approved for financing and you pledged collateral to secure the funding, then the lender will file a UCC-1 financing statement with the Secretary of State. This creates a lien as against the asset. Credit reporting agencies add this information to a company's credit report. The media is another source of information on companies. This includes communication platforms such as news stories and press releases. Sources can be online or offline. The federal government has more information. Their data includes any company grants, loans, contracts, and debarment. Debarment means exclusion from certain items such as contracts due to transgressions like fraud. Information also comes from business registrations, which include details such as a company's incorporation, the date of the incorporation, and the current status of the filing. Business registrations can be listed in courts at state, county, and city levels. Incorporation filings also have a wealth of information. If applicable, such a filing goes on public record with the state's Corporations Division. Other submitted data includes shareholder specifics and corporate financial reports. Directories of companies are another source of information. This includes the yellow pages. Directories can be either online or offline. Credit reporting agencies will also look for your company online. This includes Google, a company website if any, and company presence elsewhere online, like on Yelp or Facebook. Having a company website allows you to direct some of the online narrative. If a company website is incomplete or does not exist, then D&B will fill the gaps with information they get elsewhere, and that might not be favorable information. Factor 1 is the Delinquency Predictor. D&B uses predictive models. They use predictive scoring. This takes historical information to try to predict future outcomes. D&B identifies the risks inherent in a future decision. The idea is to take objective and statistically derived data rather than subjective and intuitive judgments. But predictive scoring only represents a statistical probability and not a guarantee. The scoring system ranks and orders accounts based on the probability of late payments. It takes historical information into account and attempts to predict future outcomes. However, a new company has no historical information by definition. Factor number 2 is the financial stress percentile. The financial stress percentile compares a company to other businesses. These businesses have the same region, industry, number of employees, and/or number of years in the business. Financial stress score norms calculate an average score and percentile for similar firms. These norms benchmark where a business stands. This is in relation to its closest business peers. Factor number 3 is the financial stress score. The score is designed to predict how likely it is a business will fail over the next 12 months. Business failure means you get legal relief from your creditors. You stop your business operations without paying all of your creditors in full. You voluntarily withdraw from your business operations and leave unpaid obligations. You enter into receivership or reorganization, or you make some sort of arrangement for the benefit of your creditors. D&B scores range from 1001 to 1875. A score of 1001 represents the highest probability of business failure. A figure of 1875 shows the lowest probability of business failure. Factor number 4 is the financial stress risk class. D&B scores your company. The numbers range from 0 to 5. A 1 is the business's least likely to fail. A 5 is firm's most likely to fail. A D&B customer can quickly divvy their new and existing accounts by risk and then decide how to proceed. But what about a 0 score? You get an automatic 0 score if your business is shown as discontinued at this location, higher risk, or in an open bankruptcy. Factor number 5 is the financial stress score percentile. This score ranges from 1 to 100. A 1 percentile is most likely to fail. A 100 percentile is least likely to fail. It is a comparison to other businesses. If D&B identifies your company as financially stressed, that means you have ceased operations following assignment of bankruptcy. You have voluntarily withdrawn from business operation with unpaid obligations. You closed up shop with a loss to creditors. Your company is in receivership or reorganization. Or you have made some sort of an arrangement for the benefit of your creditors. Factor number 6 is the Supplier Evaluation Risk Rating, also called SER rating. It's on a scale of 1 to 9. It predicts how likely it is your company will get legal relief from your creditors or end operations without paying creditors in full over the next 12 months. Once D&B calculates the financial stress score percentile for your company, they apply a second set of rules to figure the SER rating. A 1 means your company is least likely to fail to pay your own suppliers. A 9 is the opposite, showing the highest likelihood. Factor number 7 is the credit limit recommendation. A D&B credit limit recommendation includes 2 recommended dollar guidelines. A conservative limit. It suggests a dollar benchmark if a company's policy is to extend less credit to minimize risk. And an aggressive limit. It suggests a benchmark if a firm's policy is to extend more credit with potentially more risk. D&B bases these dollar guideline amounts on a historical analysis of the credit demand for companies similar to your business. This is with respect to employee size and industry. The guidelines do not address whether your business can pay that amount or if you hit your total credit limit. D&B assesses how likely you are to continue to pay your obligations within the agreed-upon terms, and how likely you are to undergo financial stress in the next 12 months. Factor number 8 is the Composite Credit Appraisal. This number, between 1 through 4, makes up the second half of your firm's rating. It reflects D&B's overall rating of your business's creditworthiness. They analyze company payments, financial information, public records, business age, etc. If your company does not provide current financial information, you cannot get a rating of better than a 2. The 1R and 2R rating categories show company size only based on the total number of employees. They are assigned if your company's file does not contain a current financial statement. Employee range, ER ratings, apply to certain lines of business not lending themselves to classification under the D&B rating system. These kinds of businesses get an employee range symbol based on the number of employees and nothing else. Factor number 9 is the Paydex score. A Paydex score is Dun & Bradstreet's dollar-weighted numerical rating of how your company has paid the bills over the past year. D&B bases this score on trade experiences reported by various vendors. The D&B Paydex score ranges from 1 to 100. Higher scores mean a better payment performance. Paydex scores reflect how well your company pays its bills. A 1 is 120 days, slow payments. A 100 is prompt payments. A mid-range, about 50, means 30 days slow. Factor number 10 is the D&B rating. A D&B rating helps companies quickly assess a business's size and composite credit appraisal. Dun & Bradstreet bases this rating on information in your company's interim or fiscal balance sheet, plus an overall evaluation of the firm's creditworthiness. A scale goes from 5A to HH. These rating classifications show company size based on worth or equity as computed by Dun & Bradstreet. D&B assigns such a rating only if your company has supplied a current financial statement. The rating contains a financial strength indicator. It is calculated using either the net worth or issued capital of a company. If both figures are available, the net worth will always be used. D&B will show if a business is new or if they never got this information. It also adds a condition code or risk indicator. This measures the amount of risk the creditor can expect. It takes into account key items in a D&B business information report, which are used to predict the likelihood of a business failure. A company gets the lowest rating, 5, if no information is provided. By definition, a startup company is considered to be high risk because they have no commercial credit score. Stellar personal credit doesn't matter here. D&B is just trying to figure out if a company can pay its bills. Since D&B doesn't know that for sure, they err on the side of caution. Recap for 10 factors you need to know which affect your D&B report. D&B gets your data from a variety of sources. You have control over some of these, such as your company website. Paying on time impacts your score more than anything else. Much of the report concerns D&B's predictions of whether your company will fail within the next 12 months. But past performance is no guarantee of future results. Contact us today to learn more about 10 factors you need to know which affect your D&B report.